Good day, guys. Welcome to Trading Arbitrage Opportunities with Calvin Port. Welcome to episode 34. Uh, Previously, we talked about gold, silver USD. Silver USD. Hope you can see it. So, we talked about silver USD taking over, uh, probably because of the collapse in the USD, and that the trade will continue. It might give us a tiny pullback, whatever it does, but at the end, the trade will pump. The reason why the trade will pump is because the euro, the USD is take it has to price in the tariffs and uh, those what do they call it? I forgot what they call it, but those are the impeding of the trade market sanctions. So the sanctions and the tariffs are being priced in, and the reason why I don't trade this silver USD is because of the negative swap. Every single day that you hold these trades, you're gonna be paying minus 6.65 points for each day that you hold the trade, which are called swaps or just overnight charges. So I'm a carry trader. I normally take a positive carry. So this is a negative carry. And the reason, okay, let me show you what the negative carry does. Negative carry, this is what a negative carry does to your trade. Let's say your entry level is here. Let me change it into red. Let's say your entry level is here and your stop loss is below that. So every night that you pay this minus 6.65, a normal day is 50 points or just 50 pips. So what happens is that that you trade, every night that you hold the trade, you will be paying 6.65 points. These are not percentages, they are points. So your entry level will be moving higher and higher overnight. You won't be able to see this on MT5, but bit by bit, your entry level will be moving higher. And if the market reverses without you taking profit, you might find out that the market is up here, is not below the entry level of yours. But even though it's up here, you might find out that when you look at your profits, you're already in the negatives, but the market is actually up here and your entry level is here and you're already in the negatives. That's because your entry level moves higher and higher overnight. You won't be able to see this. Your entry level will stay at one place, but because you're paying the swap, your entry level will be moving higher, but you won't be able to see it. I normally call it a spiritual entry level movement, but here we're not talking about spiritual things. So the trade that we are taking is called an economic divergence. You want to, let me show you what an economic divergence is. Let's say silver is economically bullish. I told you guys that the reason why we buy commodities at this time of the year, in fact, between October, November, December, towards the closure of the year in the southern hemisphere, every single year, commodities are going bullish at this time of the year towards the closure of the year. And those commodities are pushed by the economy of the southern hemisphere because we are going towards the closure of the year. And remember, it is summer in the southern hemisphere, and everybody is about to make a lot of money and pay bonuses to their employees. So that's the reason why the commodities are pumping at this time of the year. And we are looking at the dollar. Since this is gold, let me paint it in the golden color. This is gold. or just silver, it's silver. But I don't have a silver color, so I'll paint it like this. And let's say this is the US dollar. US dollar is moving lower and lower and lower. So the USD is green. So the money in the US dollar is green. So what we this is what we call an economic divergence. One economy is gaining and the other economy is collapsing. So we call it an economic divergence. So the difference between the market price in this economy of gold or of silver and the the market price in the economy of the US dollar, the distance in between the two, in fact, I have to put it like this, the distance between the two from here all the way down here, this difference here, it's called an arbitrage opportunity that we're trying to take. Just like how I was talking about inflation on the previous videos, I was explaining what an arbitrage trade is, like where I said one economy is exiting the one where I was talking about inflation and GDP. I said one economy is exiting the recession, and this currency is getting deeper and deeper into the recession. And because we know that eventually, because of the central bank decisions, eventually the US dollar will exit the recession. So the time that will take the US dollar to exit the recession, it's called an arbitrage opportunity. The reason why we have this word. So we are going to buy this currency. We're going to buy this currency and sell this currency and wait for this currency, the inflation in this currency and the GDP in this currency to catch up with the GDP and the inflation of this currency. That strategy, we call it, wait a second, I will type it for you. I'll type it for you. I'm sorry about my clumsiness. So the trade that we're going to be taking, it's called hedge inflation. We are hedging the inflation of this currency with the inflation of this currency, and we're using the losses in this currency to pay for the currency that we are buying. So that currency is called hedge inflation, but it only happens. This is what I call the major bust. When I talk about a major bust, I'm talking about hedge inflation. Let me draft that major bust for you. So whenever I talk about the major bust, when you hear me talking about the major bust, I'm talking about hedge inflation. So these ones only work when one inflation is catching up with the other. So the arbitrage opportunity is when we have an an economic divergence. You can call them both arbitrage opportunities because those are the opportunities that are taken by the hedge funds. They call them hedge funds. They call them hedge funds because the strategy is called hedge inflation. That's why they call them hedge funds. I believe that you can Google hedge funds and see what hedge funds are, or mutual funds. Those are just the the financial institutions that we pay our pension to, where you invest your money. The difference between a hedge fund and a mutual fund is that A mutual fund is a fund where you can invest any kind of money, like 1,000, and it's for citizens, all kinds of citizens. They can invest in a mutual fund, and a hedge fund is for farms, factories, companies. So they will tell you that the minimum amount of money that you can pay for each month is 1 million or 2 million or 5 million per month. So we cannot afford that. We go to the mutual fund. The hedge funds, they pay more in interest, and those are for the businesses, the farms, and anybody else. So, but the hedge funds and mutual funds are just the same thing. The only difference is that one guy is a mediator for businesses, they invest for businesses, and the other guy invests for individuals like you and I, like Old Mutual. So those are called mutual funds and hedge funds. So I believe that these are the two strategies that I trade, which are economic divergence and hedge inflation. You will, whenever you hear me talking about hedge inflation, you need to know that I'm looking for a major bust out of an economic cycle. An economic cycle is where we have an interest rate cutting cycle or an interest rate hiking cycle. So when we have a hiking cycle, that means the economy is booming. When we have an interest rate cutting cycle, that means the economy is moving towards a recession. But recessions are global, so we call them it's a global recession or a global booming of an economy. So at the moment, what we are trading here, we are talking about commodities doing the same thing over and over again every single year, just like on that Euro Turkish lira trade. So we're going towards the closure of the year in uh, in the southern hemisphere, which is between October, November, and December, where commodities are going bullish because we are selling our goods much faster and businesses are doing well because it's towards the summer. A lot of people are getting bonuses. They're ready to spend money. So that's the trade that's an economic divergence that we are taking here, and the dollar is pricing in the sanctions that we're talking about, the sanctions and the tariffs. You know, I don't trust the US. I just want to tell you guys, I don't trust the US, especially the US dollar, especially when we have that president called President Trump. This thing can just go bullish for no reason. He might be saying something right now, and you might see the dollar pumping for no reason. So at the moment, the dollar is still telling me that it is bullish, but at some point, it will give up on. At some point, it will give up on its bullish direction. Remember, we are still moving towards September, where we are pricing in the sanctions, and we're expecting it to collapse. At the moment, it is the dollar is repositioning itself for sales. That means the hedge funds are not happy with the market price where they were supposed to be buying the US dollar, so they need to push the market higher in the USD and break the previous high so that they can be ready for sales in the dollar. Remember, I'm talking about a dollar separately. I'm not talking about two currencies. I'm talking about one currency. So here we're trying to take advantage of what will happen in September, the pricing in of sanctions and tariffs in the US dollar. And here the commodities are normally going bullish every single year because the southern hemisphere is going towards the closure of the year. A lot of people are going to have enough money for spending. Consumer spending will will grow much will grow much higher, and because of that, that is the economic divergence that we're trying to take, which is an arbitrage opportunity for central bankers. Remember, this trade with silver and the US dollar will repeat itself towards the closure of the northern hemisphere, which is between April, May, June. That will be summer in the northern hemisphere. So it's just the opposite of what we are doing at the moment. So goodbye, guys.